Hello, everybody. Welcome to today's episode of the Daily Dose. Today is Monday, December 19th. The markets dropped again today for a fourth consecutive session. The S&P 500 was down 0.9%. And you got a lot of headlines saying that markets dropping off fear of rates going higher, things like this, following the FOMC meeting last week where interest rates were raised 50 basis points. But, I mean, this is what the market was expecting. The expectations going into the meeting were 50 basis points. All through this rally, the expectation is that the interest rates would get raised by 50 basis points. So why is the storyline in the market that the market's going down because of that rate hike? It doesn't make any sense. Why would the markets go up before the rate hike if that's what we were expecting and then go down after? I think a lot of it has to do with just market psychology, the psychology of just people during bear markets, of that cycle of extreme hope and then extreme despair. But also, I think the financial news people, they have to put out stories every day. And they're just going to go ahead and slap some kind of storyline on a headline with whatever the market did that day, when in reality the two are not as connected as we might think. I mean, obviously, the market is tied to interest rates. That's not what I mean. But the storylines are more made up by the media and not necessarily fact. So I think that the reality of the situation is that we still have inflation year over year at 7%, whether or not it's peaked or it's going to drop really fast. To me, that matters, but we're still at 7% inflation year over year, and that's way too high. The Fed's target is 2%, so that's over triple of the Fed's target rate. But inflation is bad for all of us, everybody. That's not the government. Inflation is bad. And it debases our money. It debases our economy. And there's a number of reasons why the market does not move higher during inflation, a period of inflation. But one of the reasons is the interest rates and the Fed raising interest rates to combat inflation. But we've never seen interest rates go up this fast, this quickly. Interest rates are up 16x from the bottom, and I know that's a low base, but in the inflations episode that the U.S. had in the 70s and 80s, the interest rates went up only 2x. So to see a 16x rise in the interest rates is a shock to the system. It's a shock to the equity markets. There's also a number of reasons why the stock market goes lower when interest rates are higher. The main reason being that money will come out of equities as interest rates go higher because there are safer investments now yielding a higher return. And so people don't need to take on as much risk as they did when interest rates were lower or at zero, as they were right about at zero. But there's a number of reasons why it's happening now. And another reason is because the economy is sick. You can make the argument whether or not we've been in a recession since the beginning of the year. The government would say no. Some people would say yes. But interest rates do damage to the economy. It puts people out of jobs. It weakens the job market. It decreases demand for discretionary items, so it hurts those companies. It hurts a lot of businesses. It hurts the housing market because mortgage rates are higher. It hurts a lot of things. And in a period when we're already kind of experiencing this economic sickness, and then you have inflation on top of it, and the Fed has to then raise interest rates, you're doing more damage to the economy trying to fight inflation. And there's just a number of things pushing this market down. So I think the rally was basically just, to me, pure euphoria, because we knew the expectation was a 50 basis point rate hike from the bottom here up. That's what we were thinking, or not from the bottom, but but from the beginning of November, so from here on, we thought it was going to be 50 basis points, and the market rallied. So the fact that we're coming back to, I mean, today we're basically at the same price that we were at back in the beginning of November. So we've basically just retraced all those gains. The fact that we're back there just tells me that that rally was euphoria. There was no fundamental basis for it. We hit the technical level, we hit the trend line, we double topped at the 4100, and now we're heading lower. Um, at the least, I'm expecting to hit in this level here around the relative lows back from June. But I would be expecting a retest of the low from October for sure. And honestly, I think that this is the beginning of another leg lower. I think that we could definitely see the 3250 level somewhere in this range. I have mapped out from 3200 to about 3280. And I think that that's a next good level for the market to go to. And that's what I'm looking at a technical level from the market. So fundamentals haven't changed. We are still seeing really high inflation, even though it's coming down. Interest rates are going up. They're continually going up, even though they're going up by only 50 basis points this month. They're still moving higher. We were at 0%, and now we're sitting right about, I think we're between 4.25 and 4.5 right now on the federal funds rate. It's expected to at least hit 5.1%, but that could change. So, I think this market's going to stay in the channel it's in. I think at the least we see the 3250. That won't even be a channel touch. It could definitely go deeper than that just on this leg that we're kind of starting to form now. But that's what I'm looking at in the stock market. We'll take a look at Bitcoin before I leave it for today. So let's take a look at Bitcoin. Bitcoin's kind of been moving with the market. It retested the bottom of the zone that it was in for 5 months, rejected it. We continued lower. We're kind of just sitting here. Bitcoin's acting really technical, if you can see the candles. It's still in this gigantic downtrend from 69,000. We're sitting at 16.6 right now, so it's been severely depressed. And I think Bitcoin's still heading lower as well. I think if we get this new low in the stock market, I think you'll definitely see a new low in Bitcoin. I think that if the market capitulates downward faster than what people are maybe expecting, I think we could get that extreme surge downwards in Bitcoin too, maybe to the 12,000 to 10,000 level. That's kind of what I've been looking at. There are a lot of people calling for that level, so if it actually cracks lower than that or stops right before that, I wouldn't be surprised. But that's generally a pretty big range. You know, it's $2,000 on Bitcoin, which at that level, 10,000 to or 12,000 to 10,000 rather would be about 20%. So I think it's a good pocket to look for Bitcoin to go to next if we do see that continuation to the downside, which is what I'm personally expecting. Again, that's not investment advice. Do your own research before you make any kind of investment decision like that. But, that's just what I'm looking at. So I'll end it there. Again, if you read too much into the news, it's only going to make you a worse investor because it's going to make you emotional. It's going to make you volatile in your perspective of the market, and you don't need that. The best investors, the best traders, there's no emotion involved. You just have to analyze the situation. A lot of the time, if you try to kind of figure out the human psychology behind what's happening, it can help you be a better investor as well. So try to focus on fundamentals, technicals, get back to the basics when you're in this type of a market. Don't get caught up in all the news. Don't get caught up in the headlines. Don't get caught up in the emotion of what's going on, because you're more likely to make mistakes when that's your mindset. So I'll leave it there. Focus really is the key in this market. So I appreciate everybody watching, listening to this episode. If you like this type of content, please subscribe on YouTube and follow wherever you listen to podcasts. I would really appreciate it. And thank you. And I'll see you tomorrow.